welcome. Good evening, everybody. I will take you through, a quick update on the portfolio as well as, what's happening on the macro, and then I'll hand it over to Siddharth to take you through the topic of the month that we have written on. So on the portfolio, beginning with the coffee can continues to do well, has obviously generated 200 basis point alpha even for the month that went by. iShare Avenue and Bajaj Auto has been the best performer for the month, whereas we know Abbott and iBank has been a muted performer for the month. Moving to sort of good and clean. Good and clean has delivered a 100 base point negative alpha compared to the benchmark for the month. TVS, Blue Star, and Trend remains the best performer for the month, whereas PI Industries, Timken, and IGI has fallen in for the month that went by. Led by global sort of uncertainty with respect to tariff. Moving on to the emerging giants, we have seen obviously the portfolio had seen a drop down compared to the benchmark, led by again Venus Pi, Prajratan, and IGI, which obviously had both linkages with respect to global markets as well as some moderation in volatility in the small caps. Techno Electric, CCL, and EPL obviously delivered positive return for the month went by. Compared to that, moving from that to 10x, trend CCL and LTI has been a positive performer for the month. The portfolio obviously fell in the particular month compared to the benchmark, whereas Karvare, Venus, and IGI has been a bottom performer in the particular month that went by. Moving ahead to micro marvels, I think the landmark has done exceptionally well for the portfolio in the month of August. DJ Plastics and Eveready is another name. Whereas the money obviously was lower in food and insecticide and Mac Power. So that's a quick sort of perspective on the portfolios. We will move to the macro part, and I just wanted to just showcase or discuss on very quickly two or three things. One, obviously we all know that India has obviously been apart from 25% tariff, we also have been levied a penalty of 25% by United States for sourcing the oil from Russia and so on and so forth. But I think we are very close to signing a bilateral trade agreement with the United States. And I think maybe before the next time we speak on this particular format, the bilateral trade agreement may get announced, and market seems to be sort of believing in that. We think anything between 15 and 20% should be a number which is in line with the global markets in terms of tariff, and that should be a number that India is obviously might be happy with. So that's what our view on the tariff is. We don't think that 50% tariff is going to sustain, or most businesses will not be able to sustain this kind of tariff. Let's put it this way. Moving ahead from what's happening in the tariff to the domestic. Umang, moving ahead. And the screen is frozen. Yeah. So I think domestically, a lot of things have been sort of announced or done to look for to basically absorb the global export shock. RBI obviously rate cuts, liquidity sort of unfolding in the domestic market. Income tax rate, as we obviously know what has been announced in the budget. Subsequent with that, in the beginning of this particular month, GST sort of consolidation or GST sort of simplification from 5 slabs to 2 slabs has also led to a lot of sort of cheer in the market. Moreover, it will also lead to a demand boost in a lot of auto discretionary and those sectors. We think the impact obviously is twofold: a, the revival in the demand across categories; B, you will also see some moderation in inflation because of this particular sort of in this particular impact. So, our working suggests, 45 to 55 basis points, impact of CPI will be lowered because of the lower, pass through. And you must have seen so far, a lot of companies have already announced, rate sort of price cuts because of the GST lowering in a lot of categories. So we think this will not only mitigate but also revive the domestic demand economy as we proceed further going ahead. Moving from here to what the export opportunities that we are thinking and will actually go through. Obviously, we have seen a very strong growth in the last 5, 10 years. But please bear in mind the UK FTA. the Europe FTA that has been focused on, and also, we think the bilateral trade agreement which will get sort of signed with the US will also lead to significant amount of opportunities opening up in the next few years, particularly in, and as you will appreciate that, electronic goods, drugs and pharmaceuticals, as well as gems and jewelry are the largest sort of, exporter for the country. We think this will only, sort of gain further traction once we have, FTA and DDA signed with the global markets, particularly Europe and US. A UK FTA signed last month will also have implications beginning H2, and that will only help, exporters to build more and more sort of business going forward. Moving to next, I think these are the broad sectors, which we think, will essentially give a big, sort of focus drivers from a growth and export point of view. And these are some of the things that we wanted to sort of just, draw your attention towards. I think so from moving from export, focus to back to what domestic valuations are moving ahead. I would say the valuations are at now discount to emerging markets. From a 5 and 10 year perspective, Nifty continues to be trading at in line with long-term averages, with obviously ROE back to, I mean, obviously now even at 15%, which is similar to 2011 numbers. So I think valuations remain in line with the averages, barring a couple of pockets where multiples are very high. But improved capital efficiency means that FI eventually will come back to the country which they have been selling for the last 1 or 2 quarters. Not only that, beginning H2, we think growth will revive, and I think so. This will be a good sort of second half for the country, thanks to the both direct and indirect tax soaps given by the government. With that, I would probably comment my sort of sort of perspective, my part, and I would ask Siddharth Bothra to take over and speak on the topic of the month.
Hi, good evening, everyone. Delighted to talk about the latest newsletter that we have. In this latest newsletter, we have discussed about our learnings from one of the books we recently read, and it had a lot of learnings to be had, and especially we thought it kind of was very much in line with our line of thinking in terms of risk. So. We kind of titled it Capital Protection in a Non-Ergodic World. I'll just come to what the non-ergodic word means. Essentially, if you look at the frame itself, it talks about it that the broader thinking here is not to think short term. It's like looking at someone picking up pennies where a steamroller is approaching him. That is the essence. So there's this book called Ergodicity, which is by Luca Delena. Essentially, he talks about something which we thought was very insightful, where he talks about two things. One is, how to think about how you should play a game when you think there is, there is ergodicity and when there is non-ergodicity. So while it sounds, two different new names, but essentially, it basically is very simple. What he's essentially trying to say here is that how one particular aspect, which is ergodicity, is when the population as well as the individual outcomes on a long-term period becomes same, whereas in the other one, the individual's average is very different from the overall industry average. So I'll come to that, but so we have decided the newsletter into four different aspects. One is what is ergodicity, the key learnings from our long-term investors, the managing the non-ergodicity, and one very interesting aspect, which is a ludic fallacy in investing. So coming to, if we just take the official definition for ergodicity, it goes that a system is ergodic if for all its components, the lifetime outcome corresponds to the population outcome. Otherwise, it's non-ergodic. So I will try and explain you with a simple thing and then tell you why just recognizing whether you are playing this game or you're playing a non-ergodic business, non-ergodic game, makes so much of a difference in terms of what your strategy should be, how you should think about risk. So in ergodic investing, what he typically says is that, if you do a thing over 1,000 times, like, if 1,000 people are doing it, then that is called the population average. So the individual time series, that is, the more a number of person keeps playing the same game over and over, his average will start to come closer to what the population average is. So whenever this happens, it's an ergodic kind of a setup. Whereas, so this setup is something like, if say, if you keep tossing a coin, like, over 1,000 people, and then, individual tossing, so over a period of time, both the averages will come to the similar level. Now the non-ergodic is very different. Here what happens is that if you look at the population average, individuals, uh, this thing here is very different. Then his time average is very different because they are game overs here. That is, if you get the thing wrong, then the game's over, and so your individual's average is very different from a population average. Hence, it's called a non-ergodic world, and the risk here is very high. The risk of irreplaceable loss, the risk of permanent damage is very high here. So I'll try and explain it to you with a very simple example, which even the authors talked about, which is he talks about the Russian roulette. So if you think about, if you may have heard of this business, this particular example. So in this game, what happens is typically you take a revolver which has, say, six cartridges, and in that six cartridges, most are empty. You just, in one of them, you put a bullet, and then you put it in your head and you shoot. So the probability of you surviving, your probability of you surviving is 5/6, whereas the probability that you may die is 1/6, because there are six bullets in a chamber. Now, the difference between ergodic and non-ergodic is that if we keep playing this game, say if there's a house, and they keep playing this game over, say, 1,000 people, then the averages will always be the same. One out of six-person will die, whereas five people will survive. So the more and more you play it, the averages remain the same. But if a human being plays it, like if an individual plays it, then what happens is, then in the next second or the third one, he will definitely die, and hence his average will be very different from that of a population average. And hence, the saying goes that if you keep playing a game because one fails to grasp the non-ergodicity and mistakenly believes that the lifetime outcome equals the population one will end up dead instead of rich. So one should aim to help avoid irreplaceable mistakes whose importance is only apparent after the fact. So if we were to just draw a corollary in the equity markets, often some very risky strategies are sold. Like, let's take the case of 2008. CDMOs, or so-called the very risky strategies, were sold, where essentially what they said is that, if they kind of bring together a lot of non-performing individual loans, and join them together, then essentially as a whole they will not default, and these they were rating as AAA. But essentially what happens is that, as a system on a long term basis, this may do, but even if it cracks on one basis, or even for briefly, the individuals who invest in it will completely lose their business, lose their money. The same thing for risky investments. Like, say, assuming you think about, like, a lot of people talk about that, how if you take higher risk, if you invest in turnarounds, or invest in cases where, the payoffs is like 1:5. That is, if you lose, it's this much. If you win, there's a big amount. And then on a very long term basis, 10, 20 year, if you keep playing the same game, maybe, on an average, because the wins will be significantly more, whereas losses can only be 100%. Maybe you could say this strategy on a population level over a long term period, if you keep playing it, and have new and new players play it all the time, so as a population average could be couple of percentage points more. But the individuals who are playing it, like if they keep at this game for more than 1 or 2 years, they will definitely lose all their capital. So this is the key difference they try to bring in between population and the individual average. So what are the learnings as such from this particular example we talked about? One is to prioritize survival over maximizing returns. So, in equity markets, a lot of people most of the time talk about maximizing their returns, even in a short-term basis. Ki next 3 months, 6 months, if a particular stock you think will go higher and something else will not go, one should move from here to there. Or even if something, which is very risky, but looks like in the next 6 months will do well, buy those kind of stocks. So this is very similar to the first exhibit I showed you in the front page, which is that there's a steamroller coming, but you want to pick the pennies in front of it. So that's just explains how risky that kind of a short-term thinking is. Think in time series. The other is that you should ask yourself this question, that if I repeat this strategy for 10 years, what is the chance that I might go broke? So this is the second one. The third one being adopt asymmetric bets with cap downside. So one of the way to play, non-ergodic games is to limit your this thing to very little, that even if things go wrong, it doesn't impact your overall portfolio. And lastly, to ignore the herd behavior in bull market. So if you see, every bull market has some or the other kind of a herd behavior. Even in this bull market, if you see, there are a couple of herd behavior going on, where people have started thinking in a particular way. One of the thinking is that markets anyway gives you 15%, and if you buy in mid and small, generally I often hear people think that it can give you 20-25% return. The other thing is they believe that 5% correction is a correction. So because there's been no major volatility in 4-5 years after COVID, the sense is that maybe market has become very stable because there's a lot of investors who are coming in. But all these are assumptions, and this kind of behavior comes in a herd mentality in a bull rally. So now, just coming to the key learnings from the long-term investors from ergodicity, the first learning and the most important is that irreversibility absorbs all future gains. So avoid any game which can lead to game over. So what does this mean? Say, you have, you get into some trading, or you get into some kind of a very risky investing, where say you put 1 lakh and you end up losing 40-50,000. Then your loss is not the 40-50,000 that you lost. That is just one part of the loss. Your loss is that what this 50-50,000 could have earned you over the next 10 years, 15 years, that is also a loss to you, because that part of the money is now completely gone. You cannot get it back. And it's quite possible that in the remaining 40-50, you could have identified some really good company, or you could have got in on a market when market correction was over, and you could have made a lot of money. So avoid anything which can lead to irreversible kind of scenario, or irreversibility losses. So if you think, the Warren Buffett's number one quote, or what he says is what one should always remember is the same. He says that my rule number one is never to lose capital, and the rule number two is never to forget the rule number one. So this, as I said, then the concept of ergodicity and non-ergodicity boils down deeply to investing, and there's a lot of learnings to be had on the investing side. So if you look at the history, it's full of examples where companies and investors who have been driven by the lure of fast success and unsustainable profits, what we call the glory of shooting star, have ended up taking game over risk by engaging in riskless shortcuts and sharp practices. So if you take the case of Enron, take the case of Lehman, Theranos, the Archegos Capital, the Wirecard, the FTH, there's so many of them. That is just, I'm talking global. Even if you look at India, if you look at the NBFC and the banks, there have been so many banks which have gone belly down. There's so many NBFCs which have had difficult issues, all because they wanted to go significantly higher than the rest of the market, take risk which you knew at some point or the other will blow on your face. So while this can give you, what we show here is like the glory of a shooting star, you can have 2-3 years where you do look completely out of sync with the market, look really good, but end of the day, it's like a shooting star. So on your risk spectrum, you have to decide whether you want your performance to be like a glory of a shooting star, or whether you want it to be like a magic of compounding, where as the time passes, the it on a self-sustaining basis, it carries its own momentum, and the you approach investing more as an infinity or more as a marathon rather than a short-term sprint. So that was rule number that was learning number one. The other is many examples of irreversible losses, like investing, I already mentioned. So this concept of ergodicity goes across not just investing. The other could be sales and business reputation. So you could have a salesperson, who just to get a quarterly or a monthly target may resort to some very aggressive or unethical tactics. And while it may lead to 1 month or 1 quarter of good results, what it would lead is it would permanently damage the company's brand, and you will lose the customer's trust, which is what a business is built on. The same thing could happen on even on the investing side. Like, you could like get into very extremely risky kind of a thing, which could mean short term very good performance, but essentially will and in the end result in huge losses for your customers, huge losses for your investors, and bring disrepute for the firm. Same for say something as simple as yoga and physical health. So in yoga, if the goal is to push the body to the max, the goal is not to push the body to the maximum stretch in a single session. Instead, the practitioner aims to grow gradually without risking injury, because a serious injury can set one back for months or years, or worse, become a permanent representing a irreversible loss to on a physical ability. The same thing for a career in personal well-being. There are many young people who work really, really hard, like who, spend 18, 19 hours working, who kind of, in a way, ignore everything from their family life to their health. What it essentially helps it leads to burnout, chronic illness, broken relationships. Now, all these things, no matter how much of professional success you have, it cannot be undone. When I said the population, here the population is a company or a corporation. That corporation, instead of you, can get some other person, can put some other person in the same place. But the damage which has been done to that person, it cannot undo that. So this is again a concept of ergodicity, which you should realize that where is the difference between the population and my average being same, and playing a game where the population average is different, but my average is going to be very different if I play that game. The other is, performance is subordinate to survival. So this is actually very profound. While it seems, a very obvious thing to say that, on the long term, if you need to kind of outperform or even if you need to do well, you have to first survive. But, often people, kind of miss out on this because the temptation to do really well on a short-term basis or to kind of optimize every short-term opportunity is so much that we forget that actually on a long term basis, if you need to survive and do really well, you need to put your focus on survival, safety, and not on optimizing short term opportunities. To give you an example, say assuming you have to go from Bombay to Pune, there is obviously, every 1 2 kilometer stretch, there's a chance that you can optimize if there's no one in front and go at 100 120. But other than the freeway, if you do that, there's a chance that you may just hit someone or you may enter into an accident which could lead to game over. So game over in the sense that you may not survive to kind of reach your destination. In that way, then it's important to realize that the game here is to reach the other point, and hence the game is not to optimize how you drive every 10 minutes, every 10 kilometers or 15 kilometers. The game here is that firstly, will you reach your destination, and at what time you're reaching, within which there'll be periods where you'll be faster, periods where you have to go slow. So your focus should be more on survival. This again, the thing we talked about, that if you get into something like picking up pennies in front of steamroller, it's a very stupid kind of a thing to do. So don't try to optimize short term. Think in terms of optimizing your long term, which is 5 year, 10 year, and so on. So you will end up not only protecting your capital, but this is not something about being less demanding. Actually, this is how you create long term outperformance. So that is a very subtle difference. Like many people may see it as, okay, I'm sacrificing, so I'm not trying to maximize, I'm not being greedy in the near term. It's not that. It's basically, don't be so short term greedy that you lose your long term goal. The third point is that sustainability is a larger obstacle to optimizing short-term performance than talent. I think there's a lot of wisdom in this. Essentially, what it says is that when you see that during a hyper bull market, there are certain people who are more muted in their performance, whereas there are certain aspects who are doing really well, who are like shooting through. The difference is that you are putting a larger focus on being always ready for a black swan. A black swan event can happen anytime, and you think that to be a sustainable, if my goal is to survive 5 year, 10 year, then you put a higher weightage on sustainability than someone else. So there can be periods where someone can get away with this, but that does not mean that the risk was not there. So the point I'm trying to say is that the if the risk was there and it didn't appear or it didn't play out, doesn't mean that you did something which was very smart. There is always this saying that in the end, basically whatever is a outcome, people just look at that. People don't go deep into how it was achieved. But I think in investing, it's very important to do, because it's a long-term continuous game. It's not a game you play for 3 months, 6 months. You hope to play this game over 5 year, 10 year, or till your life. So over a period, if you keep doing something which is not making sense, sooner or later it will blow up. So here again, there's been so many, so there's this question which they ask that as a result, if you keep making conservative choices, are you really sacrificing returns by making these conservative choices, or are you trying to maximize it? I mean, I just want you guys to think about this line that, if your goal is say 10 year, 20 year, you will have certain goals of your investing. Then by being conservative, are you sacrificing returns, or by being conservative, you are actually trying to maximize your return? This is, I think, a very thoughtful kind of a question which is there. And then, the other one is the law of large number. So the law of large number is that if you flip a coin, it will half the probability says that it can be either a heads or it can be a tails. Now, if you flip it 10 times, it's quite possible that you may not get 5 5, but you may get 6 times head and 4 times tails. So the law of large numbers is that obviously if you were to kind of flip it over 1,000 times, or say over 10,000 times, then it will be 50-50. But if you do it on a 5 time or 6 time or a 10 time, the probability could be a bit different. So one should be very careful of that, because if you play a game by looking at the law of large, the ratios of large number, and don't realize that your next two, three things, you don't have unlimited retrials, you could face trouble. So, so whenever an activity which cannot be assumed to be repeatable at infinity, we should be wary of expecting to achieve its average outcome. So, there's this old saying, in Talib's book, he talks about this, that, if someone says that the river is 5 feet deep on an average, and if a person who's 6 feet decides to, cross it walking because he thinks it's 5 feet, the 5 feet was average. It's quite possible that in the middle it is 8 feet. And if you don't know how to swim, you will never survive there. So be very wary of law of large numbers, and people will keep throwing this at you. So whenever you see on TV or on media, when people talk, they will always talk the probability, the law of large numbers. On a 20-year basis, that on a 1,000 people basis, 90% people make money, or they will throw some number which does not give you the fact that you have to be careful, because as an individual, your numbers could be very different compared to a population number. The other is survivorship bias. It this is a very interesting one. It says that our Hindi scriptures also say it, but here it says that basically you should not envy someone whose position you would not be willing to take at the time of that person taking the risk. What it essentially means is that when we look at winners, we all want to kind of be like him, or we just want to mimic it. But you don't know what are the kind of risk that person may have taken to reach there. So Talib has a very famous line here, where for Elon Musk, he has a quote which goes that he has a quote on Elon Musk which says that Elon Musk illustrates the point made in Fooled by Randomness. Solid financial success is largely the result of skills, hard work, and wisdom. But wild success is more likely to be a result of reckless betting, extreme luck, and the opposite of wisdom, which is folly. So what essentially he's trying to say here is, say, assuming we go back to our first example of Russian roulette, and the probability of you surviving 2 3 by if you try to shoot your head is negligible, like it's very very low. But there is quite possible that someone may have taken that and survived three this thing. So when we envy him, we should not envy him for what he got after that. We should envy him if we should want to be like him, if we think we can sit in his place and do that three times trigger on your head, because that is where he got what he got it for. And they have this, this again is a very interesting example. So in a war, like this is a World War I, where a lot of the aircrafts came which had a lot of bullet marks in it. And they all came back, and so people studied as to how what kind of a impact bullets could have on an aircraft. But they never studied aircrafts which never came back. And it's quite possible that these were the areas where if a bullet hit, they never came back. So they just solidified areas where they thought, by looking at the planes which came back, as to where they should strengthen it, without realizing that the ones which did not come back is the thing. So that's why here they go by, don't just study the survivors, studying the missing data too. And lastly, it's again a very interesting thing, which is that it says that the managing non-ergodicity is a non-binary concept, in the sense that while when we look at the real life, most of the things we do, whether it's our relationship, whether it's investing, most of the things are non-ergodic. So how should you play this? Because you cannot just say that anything which is non-ergodic, that is my a long-term average, is different from the population average. I will not just play it, but he comes up with interesting solutions as to how you should do it. So he gives examples. So instead of going all in a single bet, take many multiple bets. Do not trust advice from non-ergodic, which is making you make it look like ergodic. And use protection, like whether it's insurance, equipments, options, etc. Set aside some buffers and reserve. And in terms of investing, there are three things we could do. One is the barbell strategy. A barbell strategy is nothing but you take risk in a very calibrated manner at the edges. Like you take a risk on 10-15% of your capital, so that even if you have a higher loss there, your overall capital does not get impacted. You look for skin in the game. So whenever you are there, ensure that the dangerous gets removed fast if you have skin in the game. And then you try to look for redistribution. Redistribution is nothing but buying insurance. So do things where you think there's redistribution of risk happening. This is one of the most interesting aspect. Maybe we don't have a live voting thing, but maybe I'll take you through this. So this is what you call the ludic fallacy, spotting such cases and investing. Taleb had first talked about it. So here he talks about that if someone were to tell you that there is a flipper of a coin who's just flipped 10 times, and out of 10 times, all the 10 times it's come head, or say 9 times it's come as head. And then the question is, the 11th time when he does it, what will be the result? Will it be a head or a tail? So, we are not live in that way. So people will have different answers, whether it's head or whether it's tails. But, someone who will use his common sense will say that, look, the 11th attempt is an independent attempt. So, you will go by the probability, which is 50% it can be head, 50% it can be tail. Now, Talib says that anyone who says that, while on a common sense basis, maybe he's going by the rules, and maybe on a technical basis correct, but he says that's a ludic fallacy, because he's not realizing that maybe the game is manipulated here, or maybe there is a cheating going on. The guy who's flipping, maybe the coin is not fair, or maybe essentially there is some other trick that the one who's flipping is doing. And hence, if you play a game thinking that the game is being governed by the rules, and it's a fair game, And if the game is not fair, there is a huge risk that you may lose your capital, because you will then go by averages, you will go by common sense, you will go by a lot of things. So you will not be able to kind of complete those things, will not work, because the game you are playing is inherently completely modeled against you and is not fair game. So here what he talks about is very interesting, which he says that always be in lookout for games where you think that it's not a fair game, and what is happening is not something which can actually happen. So that just like in ergodicity and non-ergodicity, these kind of games either you don't play, you avoid, or if you are playing, then you should at least be aware that the rules of a normal game does not play here. So this I thought was a very interesting learning, and when you look at the markets, financial markets appear to follow stable mathematical rules until they don't. So during a bull market or a low volatility regime, when almost all asset prices are rising, risk models report low danger, strategies seem safe, consistent, and profitable. But all this can be an illusion. Risks are not gone; they are just hidden, dormant, or misclassified. Everyone believes that they are playing a predictable game, but the underlying rules are quietly changing. When the regime shifts, like during 2008, during 2020, 2022, the real game reveals itself and fragile strategies implode. So this is, I think, probably the biggest takeaway one can take from this call that we are having on this newsletter. That is, whenever you are looking at a performance, not just go by the performance, go how has that performance come, and try and understand that what are the things which are leading to it. And if certain things are not making sense, one needs to be careful, because the interpretation should not be that, oh, this the risk is managed so well here that risk will not appear. It's just that either that either it was a lot of luck that the risk didn't explode, or there may be something very funny happening. Typically in all bull markets you have seen that whenever you have seen some stocks or some sectors, or some this, it's been, these things have happened in every bull market. It's only in a bear market that these things come out. So will the current bull market be very different? To my mind it will not be. So, whenever you identify something which you think is not making sense, be careful, because then you should ask the second question: is my assumption that it is following all the rules and it is following, if I continue to play it, assuming that it is as per the normal thing, will I hold true, or should I build in the assumption that maybe something is amiss here and play it very differently? So the question one should ask is, don't just model risk, ask if you understand what risks are missing or hidden. Stress test for regime shifts. Assume volatility could spike. This is the one assumption you should always make. Don't assume that 10% is a downside and market can never be volatile. Volatility can come out of nowhere. The reason it's called black swan is that none of us will be able to predict it when it comes. So it's not like that you say, okay, right now things are good, so I am having a different kind of risk, this thing. And when the risk reveals itself, I will change myself. You will not get a chance to change yourself, because the black swan doesn't allow you to. Avoid hidden tail risk. Beware of strategies that look too smooth or too consistent. Build resilience, not just return. So use a barbell strategy. Keep most capital ultra safe while making limited asymmetric bets. Survive first. Like the gambler versus house example, staying in the game is more important than maximizing the short-term returns. So, with this, we kind of complete with most of the takeaways. A quick summary. The summary is that avoiding the risk of ruin is how you get ahead in the long term. Hence, performance is subordinate to survival. Over the short term, consequences that extend beyond it do not matter, but over the long term, they do. It is not the best who succeed, but rather the best of those who survive, who succeed. This is, I think, a very key line that, when you look at on a 10-year basis, it's not the best investor who would have made the most money. It is the investor who would have survived over the next 10 years, kind to walk away from short-term temptations, trying to walk away by, trying to optimize short-term, who will probably do better. Irreversibility absorbs future gains. It's very insightful. One source of non-ergodicity is irrecoverable situations, also known as game overs. For example, bankruptcy, death, social ostracization, permanent injuries. So it is natural then that you should avoid any such risk. And as I mentioned that while uh, we cannot completely ignore non-ergodic things, but if you bring in certain of the things like bubble strategy, insurance, and so on, you will be able to handle these risks better. But more important than that, just recognizing that whether you are playing an ergodic game or you're playing a non-ergodic game gives you a significant advantage. And lastly, the ludic fallacy may lead us to believe that some situations are ergodic when in fact they are not. It is one of the more reasons to fixate on binary interpretation of ergodicity. So the last example is that you should keep questioning when something is like completely off, that are the rules, are these things being abided? If not, you should approach the game from that perspective. So with this, I kind of complete my thoughts on this newsletter, now a summary.